One thing that we don't like to admit, but most of us have, are short attention spans. We get bored easily as humans, and so we like things that move along quickly. This is evident by the fastest growing social media and video platforms. TikTok is the fastest growing video platform with over 1 billion users, and the big thing about TikTok is limiting the video length to a maximum of 3 minutes. It combines a short-length video with music to create highly engaging and fast-paced videos. You can move along from one subject to another in seconds. Instagram recently introduced Instagram Reels. This is what Zuckerberg called the next big growth driver for Instagram. This is where the company's growing. Instagram Reels, which are 60-second or shorter videos. The whole point of these videos is for them to be short, for them to keep your attention span. If they go past 60 seconds, they might lose you. And of course, YouTube doesn't want to be left out. They're not limiting their longer videos, but now they introduced a new thing called YouTube Shorts. This is basically a knockoff of TikTok. They've all taken notice of how successful TikTok is with its extremely short-form content. Now, of course, this is something that Twitter has understood for a very long time. The reason that they limit Twitter posts to a maximum character length of 280 is because they know people have a short attention span, and by limiting the posts, they'll have better success. It's without question that we have short attention spans. Otherwise, all these companies wouldn't be gearing their products around accommodating to our short attention span. And having a short attention span may be fine when it comes to consuming entertainment. But where this gets dangerous is when it comes to investing. Short attention spans are not beneficial in investing. Benjamin Graham is considered to be the father of value investing, and he wrote a book called The Intelligent Investor. Value investors treat that almost like the Bible of value investing. He said what I think is one of the best investing quotes ever. He said, quote, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine. Human behavior, sentiment, emotions, social media, this is the stuff that determines short-term results. It's unpredictable. It's unreliable. The long-term results is determined by the weighing machine. This is the actual companies themselves and how they ultimately performed. This is the fundamentals of the company, how much earnings they're actually bringing in, how much revenue growth they actually have over prolonged periods of time. The weighing machine is the determining factor of whether or not you make money in the long run." Now, Buffett has warned about investors' short attention spans for a long time. It's just human nature. We have a difficult time keeping a long-term perspective.
The answer is that investors behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow, or the neighbor says, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for huge opportunity. Just huge opportunity.
In the stock market, money's not made by being smart or intelligent. It's made by being patient, focusing on the long term, focusing on the fundamentals of companies. It's lost by making short-term decisions, having short attention spans, not focusing on fundamentals, but rather focusing on what other people are doing. Buffett mentions that people tend to push up prices when they've previously made money. We can look at the Rivian IPO that's happening this week. It was initially priced at $77 billion, which is quite a bit of money for a company that hasn't posted any meaningful revenue so far, but it has good prospects, so maybe it's worth $77 billion. Well, this was posted on November 9th, so that was 1 day ago. 1 day later, in 24 hours on November 10th, the Rivian IPO is going for $106.6 billion, which is a $30 billion increase from yesterday. It took a day for this company's valuation to go up $30 billion. Investors are very excited. Good investing should be boring, and investors that will make money over a long period of time are ones that have patience. They're ones that can stand being bored for a little bit. They don't have to make decisions on a daily basis. This is something that Warren Buffett also mentioned early on in his career. Warren Buffett also specifically talks about how you don't need to make decisions on a daily basis.
You literally every day have thousands of the major American corporations offered to you at a price that changes daily. And you don't have to make any decisions. You have to make, nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you got a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25, and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing.
This is much easier said than done. Sitting by and watching the different pitches fly by and not taking a swing at them is very difficult. That requires self-discipline. That requires being willing to be bored. That requires not living in the short term. And Buffett's very good at all of those things. Now, we know that Buffett's great at all of these things, but to determine whether or not we are, I decided to put together two categories of investors. We have type 1 and type 2, and you can see what category you fit in. This is based off of the Benjamin Graham quote, "In the short run, the market's a voting machine, but in the long run, it's a weighing machine." Benjamin Graham really does break up two categories of investors. We have investor type 1. This is the first part of the quote. In the short run, the market is a voting machine. This means that in the short term, prices reflect popularity, not the fundamentals. It's a popular vote. People go to the brokerages, they try to determine what they want to buy, and often that's based off of emotions or it's based off sentiment. A lot of times it's not attached to fundamentals. This is the short-term voting machine of the market. People in this category are always focused on the short term. They try to predict short-term price movements. You'll see them on CNBC and on YouTube doing this all the time. People in this category buy into and sell out of positions frequently. They change their minds constantly on stocks. People in this category, most notably, are more concerned about price movements than the fundamentals of their company. They don't look at the business growth and the product line and the revenue growth and the earnings. They're focused on the price. Now, if we move on to the second category of investors, we have the end part of this quote. In the long run, the market is a weighing machine. These investors focus on the fundamentals of the business. They establish large positions in quality businesses at discounted prices before others do. And they're willing to hold on to companies for a long period of time while monitoring the fundamentals. They wait patiently for the market to realize business quality and earnings. In some cases, they're willing to wait years for this to happen. Once the market does, these investors profit heavily. Investors in this category are fundamental investors. They're value investors. So while investors in the first category are focused on short-term price movements, investors in the second category are focused firmly on the company itself. Another example we can look at is Peter Lynch. He had phenomenal returns, and what they credit his success to was instead of betting on price movements, he bet on companies. He made his bets on the fundamentals of the company.
Behind every stock is a company. If the company does terrific over a long period of time, the stock will do terrific. If the company does lousy, the stock's going to do lousy. That's all you're betting on.
Peter Lynch is correct. We should just be focusing on the business. If the business does well, the stock will do well over long periods of time. But this is really difficult to do with the media today. I really believe that out of all the ways to lose money in the market, right now, one of the most threatening ways is focusing on the short term. With the barrage and the constant influx of news and content centered around finances, it's almost impossible to not get focused on the short-term aspect of investing. But most of the money to be made in investing is by being patient, focusing on the company's fundamentals, and looking to the long term. That's where our focus should be. That's all for this episode. I'll see you in the next one.